The following production is presented by League Info Site and the Credit Union Broadcast Experience, QTV.
Hello, I'm Sean Wolbert.
And I'm Glory Ledoux, bringing you the quarterly compliance update at the CU Compliance Connection by InfoSite, only on QTV. This presentation will provide information on the compliance issues your credit union has worked on in the third quarter of 2013 and the issues it will face in the fourth quarter.
Glory, it has been a relatively quiet quarter on the regulatory front, other than changes that will be imposed by the CFPB in 2014.
Right, and we have seen some recent activity from the NCOA as well of things that will happen in the first quarter of 2014.
For the third quarter of 2013, we're going to focus on the FTC, Federal Trade Commission's rules for the Children's Online Privacy Protection Act, or COPPA, on NACHA and the operating rules change, and on NCOA loan participations.
We will also go over compliance topics that you may need to implement in the fourth quarter of this year. Those topics include the CFPB's International Remittance Transfer and the CFPB's Credit Access Rule.
The FTC issued the COPPA rules. The goals of the Children's Online Privacy Protection Act is to give parents control and knowledge about the information collected online from their young children. The rule was designed to protect children under the age of 13 while addressing the dynamic nature of the internet. It's important for me to point out that the rule governs the online collection of personal information from children by a credit union, even if children volunteer that information or aren't required to provide the information to the credit union and input the information to participate in the credit union's website or services. The rule also covers credit unions that allow children to publicly post personal information. The Federal Trade Commission also made it clear when they amended the rule, and this is one of the things that I think credit unions will have the most difficulty with, is the passive collection of information that they may not even be aware that the credit union is collecting unless you talk to someone who's really knowledgeable in the IT or information technology departments. That information is collected by a persistent identifier and not just the active collection, and it's covered by the COPPA rule. The rule requires online privacy policies, a notice to parents, parental consent to information collection and use, parental access to the children's information, and parents can prevent further use or collection of information by saying they don't want the credit union to use this information or keep this information. The credit union has to maintain the confidentiality, security, and integrity of the information, and retaining personal information collected online from a child can only be kept as long as it's needed for the purposes that it was collected for.
So the NACHA operating rule changes that we're going to discuss are related to healthcare payments. Credit unions have to be able to send and receive healthcare CCD entries for health plans and healthcare providers. The rule requires health plans to clearly identify CCD entries that are healthcare EFT transactions through the use of the specific identifier, HCCLAIMPMT. No, I'm not going to repeat that twice. The rule requires an RDFI to provide or make available, either automatically or upon request, all information contained within the payment-related information field of the addenda record, no later than the opening of business on the second banking day following the settlement date. Further, this change would require the RDFI to offer or make available to the healthcare provider an option to receive or access the payment-related information via a secure electronic means.
Now, the ACH security framework, the new rule establishes minimum data security obligations for the ACH network participants. This protects the ACH data and includes 3 sets of rules, including protection of sensitive data and access controls, self-assessment, and this will be applied to the 2014 compliance audit cycle, and verification of third-party senders and originators.
Now, originator obligations for notifications of change, and this is effective September 20th. The originator's response to a notification of change, or an NOC, is optional for single entry payments. although they may choose to do so at their discretion. The rule now defines which SEC codes have an optional action, so it'll be important to review the rule for additional guidance on this.
For stop payments, the effective period of a stop payment order related to a debit entry to a non-consumer account has been revised to incorporate two additional conditions under which a stop order would lapse. The first is the withdrawal of the stop payment order by the receiver, or the return of the debit entry to which the stop payment order related. This new rule incorporates these additional conditions, reflecting current business practices and aligning to a greater extent the corporate and consumer stop payment rules.
Now on to the NCUA loan participations. The NCUA published their final rule on loan participations, which applies to both federal credit unions and federally insured credit unions. The final rule requires credit unions to adopt a written loan participation policy with certain provisions, including concentration limits, the maximum limit a credit union intends to place on its outstanding participations, and parameters for review, including a periodic review for adherence to those parameters. Also included must be underwriting standards. The final rule also includes a concentration limit on the aggregate amount of loan participations that may be purchased from any one originating lender, not to exceed the greater of $5 million or 100% of net worth. Another limit on the aggregate amount of loan participation purchases with respect to a single borrower or group of associated borrowers, which is not to exceed 15% of the credit union's net worth. Both of these limits can be waived by the NCUA with proper approval. There are also requirements for the loan participation agreement, including a provision requiring the originating lender retaining 5% of the outstanding balance through the life of the loan. Federal credit unions under the Federal Credit Union Act must require the originating lender to retain at least 10% of the loan. Other requirements for the agreement include identifying each participated loan, detail servicing responsibilities for the loan, and include disclosure requirements regarding the ongoing financial condition of the loan, the borrower, and the servicer. Thankfully, on July 3rd, the NCUA changed the effective date of this regulation to September 23rd, as opposed to the original date, which wouldn't have left a lot of time for credit unions. And the NCUA also issued a letter to credit unions regarding the implementation of this rule and how credit unions can comply. Credit unions that have loan participations that currently exceed these limits will be grandfathered until the excess has been paid off or sold in the normal course of business.
I think one of the things that's interesting to me about this is these are really safety and soundness concerns.
Right.
The things that have been addressed are things that are going to keep the credit union more safe when they're participating in a loan and they maybe don't know all the information about the loan, or they don't have control of the loan anymore.
Right.
And now that we've covered the compliance issues that credit unions have worked to implement over the third quarter of the year, we need to address upcoming compliance challenges that credit unions will have to manage in the fourth quarter of 2013.
Next, we'll talk about the CFPB's international remittance transfers, which was effective October 28th.
One of the things with the international remittance transfer rules, credit unions really do have an exemption. There's 100 international remittance transfer exemption that credit unions can be exempt from the requirements if they provide 100 or fewer remittance transfers in the previous calendar year and provide 100 or fewer remittance transfers in the current calendar year. If your credit union gets to the point where it provides more than 100 international remittance transfers in a calendar year, the rules give them a reasonable period of time, not to exceed 6 months, to begin to comply with the regulation.
Now let's talk about the disclosures. The International Remittance Transfer Rule generally requires that members receive 2 disclosures. The first disclosure is known as the prepayment disclosure and is given to the member before they pay for the remittance transfer. This disclosure must list the amount of money to be transferred, the exchange rate, certain fees, including those collected by the credit union, taxes collected by the credit union, and the amount of money expected to be delivered abroad. Disclosure of foreign taxes and certain recipient institution fees is optional based on a recent amendment to the rule. A credit union must also provide a receipt when payment is made. The receipt must repeat the information in the prepayment disclosure. The receipt must also tell the sender the date when the money will arrive, in addition to other specific information. And the rule also provides for a disclosure to incorporate both of those. So there's only one receipt. And those, again, are within the rule, and we encourage credit unions to use those examples because they are a safe harbor.
Yep, but when they use the combined disclosure, they still have to provide it before the actual transaction occurs.
Yes.
Yep. Now, there are some other temporary exceptions to the rule. Generally, all disclosed amounts must be exact. However, there are some exceptions that allow credit unions to estimate the applicable exchange rate, back-end fees and taxes, and the total funds to be received. These exceptions include a temporary exception for credit unions and permanent exceptions for transfers to certain countries and for certain back-end fees and taxes that are not otherwise required to be disclosed. For the exception to apply, the transfer must come from the member's account, and the credit union must be unable to determine exact amounts. So what we're really looking at here is, if they're transferring to a foreign country and that foreign country's bank has fees that they're going to charge, the credit union's not going to know about those fees, so that's why there's an exception built in. You may not be able to determine the exchange rate if it's set by a designated recipient's institution, and you have no relationship with that institution, and that's another example of when this would apply. If estimates are permitted, you generally must use the methods described in the rule for determining estimated amounts. These exceptions are limited and temporary and will only be available for qualified transfers through July 21st, 2015.
Yep, that's not very long.
No, it's not.
And I think one of the questions that we get frequently is that what is an international remittance transfer? And we have to remember it's a consumer-initiated, not a business-initiated, but consumer-initiated transfer to a foreign country.
But anyone in that foreign country can receive it. So
That's
although
right.
it's, initiated by a person here in the United States,
Yep.
in that foreign country, it could be being sent to a business
Right.
or a person, and it still counts.
Right. Now, with regards to the CFPB's credit access rule, there was an amendment to Regulation Z, which required the independent ability to repay only for those borrowers under 21. And what the CFPB wanted to do is there was some pushback for stay-at-home moms or people that don't work outside of the home, and their access to credit was being restricted because they couldn't show an independent ability to repay.
And I'd like to say this is something that was addressed when Regulation B went into effect. I mean, Regulation B really protected those stay-at-home moms and dads so that they had access to credit.
Right.
So when the CFPB came out with these new rules, it was extremely controversial.
Right. And so what this does is it allows credit unions to use a joint source of assets in order to qualify these individuals for credit.
And if an account has a joint account relationship,
Yep.
and funds are coming into that account, the credit union can use the funds that are being deposited into a joint account
Yes.
as proof that there is income for that member.
Yes.
So that they can qualify for a loan. Thank you for joining Gloria and I at the CU Compliance Connection, and stay tuned for future broadcasts on issues that affect your credit union.
We are here to help you at the CU Compliance Connection by InfoSite, only on Cube TV.
Thanks for watching the #1 compliance program for the credit union community. Stay tuned.